Good afternoon, and thank you so much for attending our webinar today. The webinar today is something that we're actually trying for the first time. We've not done before. Usually we have webinars that talk specifically about marketing or some specific way to go to market or something in that realm, but a few months ago, I had the opportunity to meet Matthew Capell and find out about his business, and then he did a webinar for our monthly marketing program, specifically for our most clients, and I was so excited about it that I asked him if he would present this to a broader industry, because some of the things that he talks about and the things that his company does are really, really helpful for home care agencies. And I felt like a very sound financial strategy for a home care business would allow the home care business then to allocate more of their budget for marketing. So I'm really excited to have him here today. First, let me do a little bit of housekeeping. And I have everyone on mute, which means that you cannot ask questions unless you go to the right-hand side of your screen and type your message in. And then at the end of the webinar, we will certainly be glad to answer questions. Matt's also going to give his email address, and he will send you the slide deck if you would like to have that sent to you. We are recording this webinar, so it will be available on corecubed.com events at the end of this webinar session. So again, I really thank you for being with us today, and I'll just really quickly, I will really quickly, I think, if I can. This is me. I'm Marilee Orsini. I've been in aging for a long time, and actually, other than introducing our speaker today, I'm really not don't have much of a function. So, but I'm always available for communication and questions if anyone is interested. And if you have other ideas for presentations like this, if you enjoyed today's presentation and have other ideas, we would certainly like to hear about that. Now to our speaker today. Matthew Capell is CEO of FHS SeniorCare Payment Solutions, and as I say, I ran into him at a conference. I believe it was in Pennsylvania. Matt, was that where it was, in Lancaster, Pennsylvania, earlier this year? And he is the CEO, as I say, but he comes to this business from a huge wealth of experience and knowledge. He's really had a whole lot of experience in general management and business development, and he's also founded companies and managed companies and been chief operating officer of companies. But I am impressed not only with his business expertise, but also the fact that he went to Stanford, got an MBA, and went to University of North Carolina, where he double majored in economics and psychology and was also Phi Beta Kappa. So I am, without further ado, going to change. I'm sorry, my mouse keeps moving ahead. Change the presenter now to Matt, and so Matt, I'm going to change this to you. Are you ready?
I am ready.
Fabulous.
Okay. All right. Hopefully you all can see my screen. Well, thank you, Marilee, for that introduction. I really appreciate it, and thank you to corecubed for having me today. And thanks to everyone who's taking a break over lunch to listen in. I'm sure you're all busy reading Department of Labor statutes right now, and so hopefully this will be a little bit more upbeat. So I wanted to run through the following agenda, give you a quick snapshot of who we are at FHS, and then talk a bit about various financial metrics that are important for running your home care business and frankly for running any business. We'll go through some simple examples. We'll also talk a bit about long-term care insurance specifically and how that relates to your financial statements and various revenue opportunities. And then we'll finish up with some takeaways. So quickly, who are we? We are a financial partner for non-medical senior care providers. We were founded about 28 years ago, and we are located just outside of Philadelphia. And we currently work with about 150 home care agencies, helping them to collect cash, collect revenue from both clients and also from third-party payer sources. We also help to manage certain payroll functions and help provide cash flow support for businesses. We're also very much a financial advocate for your clients. And so those clients who are trying to understand how to pay, and especially when it comes to figuring out their long-term care insurance, veterans benefits, or other third-party payer sources, we've got a team of folks dedicated to helping those clients understand what they have available. So we've been around for a while, and going around the horn here, we have, from the top right, over our history, have helped over 8,000 seniors pay for and manage their care. During the process, running clockwise, we have touched over 17,000 caregivers through our payroll-related functions. We've served over 200 offices over the years, and up in the top left, we have worked with and continue to work with over 200 third-party payers. So those are folks like long-term care insurance, Medicaid waiver, VA, hospices, nonprofits, and other strange sources of funding out there for home care. We cover most of the U.S. We're in 33 states today. No reason why we can't be in the others, and I'm hoping we add Hawaii soon so I can make a trip out there. And so let's go into financial metrics. So why do we care about financial metrics in the first place? Well, you all entered the industry for different reasons. Some of you to make a profit, and some of you to make an impact, or maybe a combination of both. It could have been compassion that brought you to the industry, perhaps personal experience with caring for an elder family member. Perhaps you wanted to be your own boss, you wanted to make money, or some combination of the above. And what I'd like for you to come away with today is an understanding that financial viability is critical for you to accomplish your mission, whether your mission is to make money, your mission is to help seniors, or all the above. If you're not a financially viable business entity, then you won't get there. There's an old adage which is, if you can't measure it, you can't manage it. And the one way to think about that is, would you drive a car without a dashboard? If you didn't know how fast you were going, how much gas you had, if your battery was still intact, it'd be very difficult to drive the car. So it's very important to have metrics, much like a dashboard, for your business. There are three key financial statements that are part of any business, and of course with home care as well. The income statement, the balance sheet, and the cash flow statement. So the income statement, otherwise known as your P&L, or your profit and loss statement, measures your business performance over a period of time. So for example, you make an annual salary during the course of a year, as opposed to the balance sheet, which measures a business at a point in time. So an income statement analogy is that annual salary. A balance sheet analogy is your bank account balance. So you may be generating salary or income throughout the year, but what shows up in your bank account balance at the end of the year, or at any point in time, is more of a balance sheet concept. So you'll often hear income statements expressed for the year ended XYZ, or for the month ended, and it covers a period of time, whereas a balance sheet will be expressed in at a period of time. And theoretically, you could compute a balance sheet every 5 minutes if you wanted to, but they typically happen at month end, quarter end, or year end. Now, cash flow statement reconciles the above two statements and really reconciles actual cash generated. So if you notice that you have generated a certain amount of income throughout the year, but all of that income is not sitting in your bank account, and of course there's a cash flow gap in between. So for example, if you worked for the last 2 weeks and quote unquote earned your salary but have not been paid yet, so an accountant would say that you have earned revenue over the last 2 weeks, but since you've not yet been paid, that cash is not yet in your bank account. And so a cash flow statement helps to reconcile those cases where you have a difference between your books and your cash balance. And like the income statement, the cash flow statement measures activity over a period of time. Now, some general concepts I want you to keep in mind and think about these, and they'll be available in the slides and the recording afterwards, so some of them take some thought. There's a saying that cash is king in business, and I want you to think about the fact that revenue is not the same thing as cash or cash flow. And I'll explain a little bit more about that as we go. Another concept is the time value of money, and that is the concept that $1 today is worth more than $1 tomorrow. And the reason, of course, is that despite even low interest rates today, the idea is that you'd rather get $1 today, put it away, and have it earn some kind of a return rather than wait for that same dollar later. So collecting cash, getting cash in the door sooner rather than later is very important. The other concept is revenue cycle. So this is a fancy word for the series of steps that must be executed to ensure you are paid for the services quickly and completely. And that busy diagram over to the right really helps to highlight what the revenue cycle looks like in home care. For example, it really begins with intake, making sure you have the right payment methods on file for the consumer that is receiving care. It's important to make sure your scheduling and all the activity and setup is done correctly. You process time and activity for the caregivers, you check that, you send bills, you send additional bills if necessary, you collect the cash, apply the cash, and potentially send out statements to the consumer as well. And this is a repeatable cycle that happens in home care most likely on a week-to-week basis. And the takeaway here is that you really should minimize that distance between point A and point B. So that time distance between the delivery of care and the receipt of cash. That's really your revenue cycle, and you want to make sure that is as short as possible. So let's take a focus specifically on the income statement or the profit and loss. What this is a representative P&L or income statement for a mid-sized private duty agency. The data comes from the private duty benchmarking study in 2014. And what you find is that for a given agency that has revenue of 100, about 61% of that revenue goes out the door to caregivers in the form of base wages, payroll taxes, benefits, and insurance, leaving you with what is called a gross profit of about 39, which is basically represents 39% gross margin. So gross margin is the amount of gross profit that results from the revenue that you generate, or how much revenue falls to the gross profit line. So in this case, it's 39% of revenue falls down to this row. You then have your basic office expenses. You have the employees that work in your office, care coordinators, marketing folks, marketing spend, rent, and other expenses. It's noteworthy that office staff represents about 8% of your total revenue for this representative agency. And then the total is your operating expenses, also known as your fixed expenses. So you can think about variable expenses up there above gross profit, and fixed expenses down in the operating line. And what you get at the end of the day is your operating profit. And so the benchmarking study would suggest that on average, home care agencies take home about 26.3% of their revenue in the form of operating profit. Now, certainly those results will vary, this is just the information from the benchmarking study. But I think what's important here is to know the difference between variable costs and fixed costs, to know the difference between gross margins and net margins or profit margins, because a lot of times people talk about margins, but you really have to say, well, which margin are you talking about? Or they talk about expenses, and you have to say, well, which expenses are we talking about? Now, the payer mix is a concept that breaks down the funding sources for your revenue. And if you look at this pie chart, it's from the industry, about 70% of private duty care is paid privately using funds from the client or their family members. And about 30% is paid by third-party sources. So many people think that private duty is 100% private pay, but in actuality it is not. Those other third-party sources include long-term care insurance, government programs, and various other funding sources and nonprofits. The way to calculate your payer mix is to think about all the different payer sources, split those out as a percentage of your total revenue, and that gives you a good sense for where your revenue is coming from. One thing to note is sometimes you can have hidden third-party payers. So, for example, we often see that a client who appears to be private pay and is paying you in cash on a weekly basis may be using third-party benefits and handling the paperwork on their own. So to you, they may appear to be a private pay client, but they are actually getting funding from, say, a long-term care policy or a VA benefit. So switching gears to the balance sheet. Again, the balance sheet is a snapshot of your financial accounts at a point in time. And there's a couple of key concepts that are important to keep track of in this business, and really any business. Accounts receivable is a concept that is when services have been provided but cash has not yet been received. So imagine that you own a restaurant and you have provided a nice juicy steak to one of your customers. They're sitting there diving into the steak. They're about finished with it. Well, at that point, you've really delivered the services. In other words, you can, what accountants would say, you can recognize revenue for that steak that's been sold to the consumer. But they haven't paid you yet. And because of that, for the meal time, that period when the person is sitting there digging into their steak, you actually should be booking accounts receivable if you were really doing your books on a meal-by-meal basis like that. Accounting rules will allow you to book that revenue when care takes place, for example, but they will require you to write off the AR if ultimately the collection does not take place in a reasonable time frame. So what does that mean? Let's say the guy who eats the steak, when you're not looking, he runs out the door and doesn't pay his bill. Well, you might have booked accounts receivable and booked revenue, but now you need to unwind that transaction and write off the accounts receivable, which is an expense through your income statement. So it's very important to collect your accounts receivable to make sure you actually get cash for the revenue that you have booked. Again, that's going back to the notion that revenue and cash flow are not the same thing. You have to convert your accounts receivable into cash in order for those to be equivalent. Now, accounts receivable aging, I'll go into a couple examples here, is the breakdown of your accounts receivable balance over time. So you can look at how old that accounts receivable is, and typically folks look in 30-day buckets across that accounts receivable. And then the final concept is days sales outstanding, or DSO. This is the average number of days it takes for you to collect cash, and that's a very, very important metric to understanding how quickly you are converting AR into cash. So let's look at accounts receivable aging. Again, this is the breakdown of your AR balance across both age buckets and clients. So if we could look at this diagram here, and I'll put up a pointer here. So client A, what this would tell you is that client A owes you $4,250 in total. But if you look at the breakdown of that $4,250, there is $1,000 that is only less than 30 days old, so somewhere between 0 and 30 days old, which means it was incurred recently. There is $2,000 that they owe you that is a little bit older, perhaps from days of care that are more in the past, so 31 to 60 days old. They have a 61 to 90 bucket, and then they've got $750 that is very, very old, so over 6 months old that they still owe you and have not yet paid. Client B has $9,500 in total that they owe you, and you notice that there's a big weighting towards the back end of this. And what's important to look at is to look at the percentage of your total accounts receivable that falls into each age bucket. And that gives you a sense for how well you are doing in collecting your accounts receivable. And what you want to see is as much of your AR as possible in the younger or newer buckets. And you want to see as little as possible out here in the older buckets, because that means you've let things slip, and that can become a big issue. So the purpose of this analysis is really to pinpoint specific client payment issues. It can help you to prioritize your collection efforts by focusing on clients that have larger balances and older balances. What you can also do is use this analysis to set staff collection goals. You can set a goal that says, let's all try to get our accounts receivable under 60 days or under 30 days. And try to develop some incentives around that. The other thing you can do is revisit your billing and collection policies. If you find that things are slipping, they're getting older, you may want to revisit what you have written into your client agreements and say, if you don't have payment terms in there, you should probably add them that say all balances must be paid within X number of days. Perhaps you impose a penalty for late payments, or you cut off service to those who don't pay within a timely manner. So it can really help you to look at those policies and procedures, or if you have them already, then you really need to start enforcing them. Okay, days sales outstanding. This is, again, the average number of days it takes to collect cash. And there's some math here, I'll warn you. So this a DSO, or days sales outstanding, is the accounts receivable divided by your average revenue per day. So I'll run through an example. Let's say an agency has $100,000 in annual revenue, and at the end of the year, they have $25,000 that is still owed to them by customers. So to calculate your DSO, you would take that accounts receivable of $25,000 divided by average revenue per day. So take $100,000 divided by 365, you get $274 in revenue per day. You take the 25 divided by the 274, and this would suggest that this agency takes on average 91.25 days to collect its cash after care is delivered. That number would not be a good one. If you think about the fact that you have expenses, you've got to pay rent, you have to pay employees. If it's taking 91 days for cash to come in the door, you can end up in a cash crunch situation. So you really want to manage that number down as best you can in order to be a healthy and viable agency. So this analysis can help you measure the speed of cash collection efforts, to set staff collection goals, also look at your billing terms and conditions. And it's really important here to compare how quickly cash leaves your organization to pay bills and compare that to how quickly cash comes in the door. So what can impact your accounts receivable and your days sales outstanding? If you think about that revenue cycle process, that distance between delivery of care and application of cash, it starts with how quickly caregivers submit time and activity records. So if they are using paper time slips versus telephony or mobile, how quickly they press the button or send that information in is really the beginning of your cash collection cycle. You can't bill the consumer until you know what care was delivered. Number two, how soon and how frequently you bill. So let's say, do you know how much care was consumed by the consumer? How frequently do you bill them? Do you bill them at the end of the week? Do you bill them every 2 weeks, every month? That really can impact how quickly you start the process of collecting that revenue, collecting that cash. The method of billing matters as well. So if you are sending out a paper bill through snail mail, that takes additional time. You have to, it travels through the U.S. Postal Service. It may travel back through the U.S. Postal Service, and those add days to your DSO because it just takes additional time for things to travel. The type of payer matters as well. So if this is a private pay client versus a third-party payer client, private pay clients, generally speaking, pay faster than third-party payers, but I'm sure many of you have had issues where a private pay client terminates care with a big balance. Perhaps they pass away and you're dealing with a probate situation to obtain money from the estate. Those are situations that can really drag out your DSO and create some problematic accounts receivable. Your requirements and your terms and conditions can also drive this. If you are setting expectations on the front end that you require payment within a week, within 2 weeks, that starts to accelerate the cash that's coming in the door. The payment method also matters. So if you are receiving payment via paper check, most likely someone is mailing that to you. That is additional days that you are waiting for cash to come in versus an electronic payment. And then processing time. Just because someone mailed a check and just because that check is sitting on your desk doesn't mean you actually have the cash. You still have to walk down to the bank, deposit that cash, deposit that check. It has to clear, and so you have an additional couple of days there that all gets tacked onto your DSO. And then finally, you have to apply that cash. So let's say the cash is in your bank account, but unless you apply it, as they say, against the open accounts receivable or the open invoice, it's really not closed out from an accounting standpoint, and it's only at that point that your accounting books at least would consider that cash to be in the door, applied, and closed. And finally, collecting prior to service is ideal. There are some folks who are able to do that, but sometimes it's impractical. The client may not want to pay in advance and may not want to pay for services they haven't yet consumed, but that's something that can help, obviously, your DSO. You could theoretically have what's called a negative working capital, where you collect cash before delivery of services. So the takeaway advice is try to shave off days wherever possible. Look at all steps in that process and see where you can skip a step, where you can accelerate the collection of cash. Drive that through your terms and conditions, through the payment methods that you take, and try to accelerate that process wherever possible. Now let's look at the other side of the equation, or accounts payable. These are the expense side of the equation, and more specifically, accounts payable is when costs are incurred but cash has not yet been paid out. So let's go back to the example of the steak, where the gentleman who's eating the steak has ordered the steak, eaten the steak, he's also eaten his dessert, had a couple of drinks. Well, he has incurred costs. So he would, on his books, have accounts payable for the amount of the meal and everything he's consumed. But because he has not yet paid the cash, and if he runs out the door is never paying the cash, he has given rise to accounts payable. So the example in the home care industry is where you have a caregiver has provided services, but that caregiver has not yet been paid. So days payable outstanding is the average number of days it takes to pay your bills. So this is cash outflows. And again, some math here. Your days payable is equal to your accounts payable divided by average costs per day. So we'll run through an example here as well. Let's say that the agency has $61,000 of payroll expenses throughout the year. And at the end of the year, they have about $2,500 in accrued accounts payable. So that would really represent the last couple of weeks of caregiver wages that need to go out the door in the form of payroll expenses. So in order to calculate your days payable, you take that $2,500 in accounts payable, you would divide it by your average cost per day, in this case your payroll cost per day, which is $61,000 divided by 365, or $167 a day, and that would yield a days payable of 15 days. So what does that mean? That means this agency must pay its payroll every 15 days on average. Now if you compare that to this agency that collected its cash in 91.25 days, you can see that cash is leaving the business much faster than it is coming in, and that can be a problem. A few things to consider with accounts payable. Industry standards, and so for example, we know that there are plenty of agencies out there. Some pay on a weekly basis, some pay on a bi-weekly basis. It typically is going to be one of the two. It's probably unlikely in this industry or in most industries in the U.S. that you're going to be able to get away with paying caregivers every month or every 2 months. So industry standards can matter. Vendor terms. So let's say, for example, you have a vendor that you use, perhaps a software provider. That vendor is trying to manage their accounts receivable. So on the flip side of the equation, they may impose certain terms and conditions that require you to pay within a certain amount of time. And so the terms that you have on the flip side in your accounts payable can matter. Sometimes they'll offer prompt pay discounts. Sometimes when you have a vendor that you use or a supplier, the supplier, again, is trying to manage their cash collections, and they may offer a discount if you pay promptly. And so keep those in mind. Those could be ways to, if you balance the cash outflows with the cash inflows, you might be able to take advantage of some of those prompt pay discounts. And then finally, relationships with vendors and payees. Perfect example here is the caregivers. You would probably have a pretty tough relationship with your caregivers if you suddenly told them you're going to pay them every 3 or 4 weeks instead of every week. So that matters. You need your caregivers, obviously, you need your vendors, and you got to make sure you manage those relationships appropriately so that they don't cut you off. And of course, payroll is your largest payable. That's going to be 61% of your revenue on average, and the industry standards to pay weekly or biweekly. So pulling it all together, cash management. Again, if you think about the payer mix, so the top left is third-party payers, the top right is client pay or private pay. And you can see down at the bottom, caregivers need to be paid in 7 to 14 days. So this can create a problem. If your DSO is greater than your DPO, so if cash coming in takes longer than cash going out, that creates a cash crunch. You may need to access cash in order to pay your payables before cash comes in the door. And the problem is that if you're growing, it can get worse. So the cash required to satisfy things like payroll grows before collections can catch up. So if you are trying to estimate what your cash cycle looks like, make sure that you are incorporating a growth component to it as well so you can see the impact of growth. So it's very, very important to manage both sides of your balance sheet, and those filter through to how much cash you end up with in your bank account at the end of the day. I want to talk a little bit about long-term care insurance as almost a case study here. The long-term care insurance is a great fit with home care, and over 50% of LTC claims actually begin in home care, which makes sense. Typically, people like to age in place. There is typically home care in the grand spectrum of senior care is a lower acuity, so it makes sense that the first time a claim is open, the first time a policy is used is in home care. 75% of the policies out there have a daily benefit maximum between $100 and $200, and so there's a good amount of money out there in these policies that is available to pay for care. And one of the things that we looked at, and I'll provide a little bit of data here, is we did a study because we had read a lot of press about long-term care insurance and hey, isn't it going away? And we wanted to dig into that a little bit, understand what the truth was. And what we found is that, to provide some context, in your industry today, there are about 1.7 million seniors who are receiving non-medical in-home care. And what we found is in the long-term care insurance industry, we said, well, how many policies are out there? And we found through some research that there are about 7.3 million policies outstanding. And if you believe what was in the media, you might guess that, well, they've already been used. They've already been used up, or they're about to be closed, and there's not much left, and so this long-term care insurance opportunity has already passed us by. Well, that's not the case. What we found is that there are only about 243,000 policies that are currently what they call on claim, or about 3% of the total, which means that 97% of the policies, or about 7.1 million policies in the U.S., are sitting there ready to be opened. So we like to point out that if you haven't had a lot of long-term care insurance policies come to your office, they're coming. But what is the revenue opportunity here? What we found is that on average, the claim amount, or the dollars that are consumed out of a policy, is about $30,000. We saw a range of about $30,000 to $48,000. So assuming the low end of that range, there is about $200 billion of long-term care purchasing power sitting in the long-term care insurance policies out in the market today. And so it's a tremendous opportunity. And what you see in the press is that there are news reports about traditional long-term care carriers that are facing challenges. And this is true. These policies were written largely in the 80s and 90s, and the estimates they made about how long people would live and how much care they would need were largely wrong. And so insurers have been suffering some losses there. They mispriced the policies. And so some carriers have petitioned state regulators to raise premiums on current policyholders, sometimes 10% or more, and those challenges have caused some players to exit the industry altogether. Now, in some ways the damage is already done. They've already issued a lot of policies. They may have exited the new sales, the sales of new policies, but many of them have a book of business they still need to manage. And if you look down at the infographic below, you can see that the largest single year amount paid by certain companies. So Company C here has had some problems. They've had to pay out for a male over $225,000 for a single individual in a year, and almost $350,000 for a particular female client. And so it's those kinds of busts in their financial model, if you will, that have caused some issues with some of the traditional LTC carriers. But despite that, the overall LTC market continues to grow. Now, 12 of the top 20 carriers are still marketing LTC products today. Some that left the industry actually came back and figured out better ways to price their products. The other thing that they are doing is coming up with innovative new products. So you'll now see a lot more hybrid life/LTC products where the policy, if used before death, can be used for long-term care insurance, but the remaining value or unused portion can convert to a life insurance distribution upon death. So those policies are not only more attractive for the consumer, but they figured out a way to price them more appropriately. And so because of that, while the more traditional LTC policy number is declining, or at least the new number is declining, the overall market is still growing, and it's been driven by new financial products that the industry has been offering. And that's good, because that means that over the long term, this funding source will still be a viable option for seniors as they consider ways to pay for care. But if you think about how LTC relates to our discussion about your financial statements, third-party billing can be messy, and helping clients can require a lot of operating expense. So think back to your profit margin, your net profit margin, your fixed expenses. It can tie you up. It is a burden to spend all that time on the phone with carriers, trying to decipher policies, trying to send in paperwork, and whether that is done by you or that's done by the consumer, it's a hassle. And the policies are very complex. Even the carriers have trouble interpreting their own policies. We've had many issues where we've contacted a carrier on behalf of a client or on behalf of an office, where the carrier will fully admit that they'd never seen this clause in their own policy before. Perhaps it was a 1988 vintage policy, and back then the policies were written with clause 52 in them. And even the carriers who wrote those policies are finding 20, 30 years later that they have to figure out how to interpret those clauses for the new world. And so it all adds to complexity. The other issue is long DSO. So the payment time frames from long-term care insurance carriers can be long, and it can be erratic. Sometimes they're paying you every 3 or 4 weeks, and then all of a sudden it takes 6 or 8 weeks. So you have to stay on top of things. You have to make sure that you have to keep the carriers honest and stay on top of things. However, we find it's a great opportunity. We find a lot of offices are out there using it to differentiate themselves. There are 25,000 home care offices in the United States today, and because of this wave that is coming, some people have really used it to their advantage and made their office a welcome place for LTC policies. So this can open up new revenue sources for you as well. If today you have no long-term care policies in your payer mix, this can help open up new revenue sources. And the final point is that many third-party payers actually refer clients to you. And so by getting yourself established there, you can actually get increased client flow and referrals. So in conclusion, keep your eyes on the metrics. Develop some metrics. Keep it simple at first. Keep it to a limited number, maybe 5 or fewer metrics, and calculate them. Calculate them every month, every quarter, and keep your eyes on them and figure out ways that you can manage them down. Remember that the income statement and the balance sheet are important, and what really bridges the two is your cash flow statement. So don't just focus on your revenue and your billable hours. You also have to look at the cash in your bank account and make sure that you are converting that revenue into cash. Now, Microsoft Excel is your friend. I'm a bit of an Excel nerd myself. My early career was on Wall Street, and so I'm a heavy Excel user. And I think it's worth taking a course in Excel if you haven't done so already, because there's a lot of neat things you can do in there to help you keep track of your numbers. And analyze your payer mix. You could be potentially missing opportunities if there are some slices of the pie that you don't see in your own business. And then accounts receivable and DSO, make sure you examine that care to cash cycle. Write down all the steps that start with intake all the way through to posting of cash, and try to shave off those days wherever possible. And then finally, plan for growth. Make sure that if you have a disconnect between days, DSO, or the number of days until you collect cash versus the speed at which cash is going out the door, make sure you have a cushion. Make sure you have cash in the bank in order to support that growth as you move along. Okay, so finally, and we'll have, I think, a little bit of time here to do some Q&A over the webcast system. I'll give you just a little bit more information on what we do. So if you go back to that pie chart of your payer mix, what FHS does is really helps you with your entire payer mix. We can help you to get established with third-party payers. We can help your agency to provide third-party billing services on an outsourced basis. Sometimes what we like to say is we can work for you or we can work for the client. And we can help with the administrative burden of submitting claims, and we can also help with the cash flow aspect, which I'll explain here shortly. This is a busy diagram, but part of what we do above this yellow line is we are essentially helping you to collect cash. So we provide a variety of billing services, both from the client perspective and from the third-party perspective. So we provide client billing, payment processing, and statement services to help make sure clients are paying promptly, and you reduce that that DSO from clients as best as you can, but also provide a great payment experience for the client or their family members. Then on the third-party side, we do, as I'll explain, a pre-cert process. We help to verify benefits first, and then we do all the hassle legwork of preparing claims, pulling together the caregiver notes, sending off the invoice to the third party, following up on the claim, making sure they pay in full and pay promptly, and remit that cash to you. As part of what we do, we step into the what's called the assignment of benefits, or the AOB. And so the payments from the third party are made directly to FHS so that we can make sure we're stepping into that AR on your behalf. And part of what we do below the line, obviously we distribute that cash to you. We can provide payroll funding as well. So going back to that situation where it may take 60 days for dollars to come in from a third-party payer, but you have to pay payroll on Friday. We can help to advance some of the third-party funds to you so that you can make payroll and make sure that your caregivers are paid and happy while we're waiting for the rest of the dollars to come in. So we can help do the administrative component and handle those hassles for you, but also help manage that cash flow issue as well. And then finally, we can also provide on an optional basis if you needed help with payroll processing or potentially fully outsourced HR services from our PEO partner, which stands for Professional Employer Organization. We can help you with that as well. And so in some ways, a very simple way to think about it is we help manage the money and transactions that impact your accounts receivable and your accounts payable. And as I mentioned earlier, third-party benefit verification is something that comes with all of our third-party billing services, and this is oftentimes something that clients find the most valuable. We have a team of people. They are long-term care insurance and third-party insurance experts, and what they do is they start when you have a client that you've identified that may be interested in your services, and you find out that they have, for example, a John Hancock policy. We will actually reach out to the third-party payer on behalf of the client and on behalf of your office. And we will spend the hours on the phone with that third-party payer to understand the client's specific policy, what it pays for, what it doesn't pay for, things like their elimination period, their daily benefit maximum, their lifetime benefit maximum, if they have inflation riders, all those different bells and whistles associated with the policy. And then we communicate it back to you and your client so that the client can feel comfortable to have a payment source in place, and you can as well, to make sure that the care will be paid for. So in summary, we can help you in the top there expand your payer mix. So again, getting all the slices in that revenue pie that could be available to you. We can help differentiate you. So if you're out there marketing to those 7.1 million unopened policies, and really raise your hand and say that you're that long-term care insurance is welcome in your office and help you differentiate from the guys down the street. We can help to reduce operating expenses because we're an outsourced service and we're essentially surge protection in a lot of ways. We've got a team of people that can handle financial operations, billing, and collections so that you don't have to waste time doing that internally. You can focus on getting clients and recruiting caregivers and the things that you really got into business for in the first place. Because we've been doing this for so long, we've come up with some great process for lowering your DSO. So we know how to manage that revenue cycle. We know how to manage that care to cash cycle and lower your DSO with better process and electronic payments. And from a payroll standpoint, we can also help to manage your payroll processing through what are called ASO services. So think of that as more traditional payroll processors like ADP, and then PEO services, which are fully outsourced HR services. And then finally, we finance your payroll liability. So we can advance you the funds required to meet payroll. So it is much easier to work with third-party payers and make sure you pay your caregivers in a timely manner. And so that concludes my presentation. I really thank you all for your attention. Marilee, I'll leave it to you to take things away from here. I'm not sure if we wanted to leave time for questions.
And we do have a couple of questions. I want to leave this slide up just for a minute, Matt. Thank you very much. But this does have your contact information on it, and if someone is interested in your services, they can contact you there, or if they would like a copy of the slide deck, then they may do that as well. I will take the presentation back to me, and for questions and answers. And I just have a couple of questions. One is, could you further explain fixed costs versus variable costs?
Sure, absolutely. So the way to think about variable costs, especially in the home care business, is essentially you provide your services on an hourly basis, an hourly or on a per diem basis. And so variable costs are those that vary with the delivery of the service. So for example, if you charge $20 an hour, there are certain expenses that will track the number of hours provided. So for example, if labor is the most obvious one, where if you provide 1 hour of care, you're going to get $20 of revenue, but you might have $12 of expense. But if you didn't provide that hour of care, you wouldn't have the $12 of expense. And so variable costs track the delivery of services. Fixed costs, on the other hand, you have to pay no matter what. So rent. Your landlord doesn't care how many hours of care you delivered during the month. That rent number stays fixed and must be paid out the door. Same thing with your staff expenses typically as well, unless you have some folks who are part-time and variable. So the fixed costs are those things that are typically the same every month and do not depend on the number of hours of care that you're delivering, whereas variable costs do depend on the amount of care being delivered.
Okay, thank you. The next one is, other than using your services, which appear to be wonderful, how could someone shave off days? Can you give me some examples?
Sure, absolutely. I think one of the things that we see is, number one, starting with the caregivers and making sure they submit their time and activity promptly. We've had cases where a caregiver might wait 3 weeks to submit their time and activity, and that's a problem. So it helps to set some policies, set some ground rules with the caregivers to make sure they submit their time very promptly so that you can complete your billing. The other thing is with how you bill and how you collect. And so I think the other thing that we hear a lot is folks who If care is delivered this week, at the end of next week, they'll put together an invoice and send it to the client. Well, between this week and next week, that's a week of time that you're not getting paid. You then travel through the mail for a few days. It shows up at the client's house or perhaps the family member's house. It sits on their desk for a few more days before they decide to pay. And so the manner in which that you send a bill and collect that cash can really extend the time frame to actually receive cash in the door.